I think the take today on AI is very tribal. There are those that are quite optimistic about its power, its ability to transform the world. Along with the AI optimist view comes big implications for potential job loss as AI replaces many jobs out there in the marketplace. And then on the other side, there's a group that thinks a lot of this is hype and that especially current valuations in the marketplace today are looking bubbly. We're seeing big moves in stocks, perhaps getting ahead of fundamentals on the promise of what AI means. And not even whether AI will be important, that's not even the question for this group, but a real question is if valuations get ahead of where they should be, an unwinding of that could be pretty painful for the markets and for the economy. The stakes are just much higher today than they were a year or two ago in terms of economic impact and consumer sentiment around AI usage. Today in this video, we're going to talk about how high the stakes are surrounding this debate, how hard it is to call a bubble for us, but honestly, for anyone. And we'll talk about the mileposts that we're going to be tracking that'll help us answer these questions, and the portfolio positioning that we think can help ensure our clients against any of these potential future paths. At City Different, I think as long-term investors, we need to focus on investment strategies that work over the cycle. So we're always investing in a way that has investments in our portfolios that could work if the economy goes into recession or not. It's always been a long part of who we are. There are real implications around whether this is a bubble or not in valuations and market moves related to AI today. And what's important for us is to stay focused on the long term with investment strategies that work, whether this is a bubble or not. And I think in our communication with our clients, especially RIAs, helping them remember potential implications of a bubble, what could happen if this does look like the 2001, 2002 breaking of the internet bubble, but also being realistic about the potential for the market going a lot further and maybe over years before there's a pullback. So it's a complicated time for RIAs and their clients, but keeping that long-term perspective we think is really important. It's important to realize that a meaningful slice of US GDP is downstream of the current AI build today. Estimates on this vary, but Jason Furman, a Harvard economist, thinks something like more than 90% of GDP growth in the US right now is tied to build out of AI capabilities. And AI CapEx is just continuing to grow. Morgan Stanley thinks the combined AI CapEx will be something like $800 billion this year, growing to over $1 trillion, more than $1.1 trillion next year. I think it's just also important to remember that all of this GDP growth driven by AI today is not productivity on the back of using AI in companies across the economy. It's really CapEx build, it's capacity build against AI demand. And you've got to remember, capacity build is always sort of one time in nature. Now, we think this demand is going to continue, it's going to continue to grow, but if we get to a point where supply outpaces demand, it's not that CapEx declines slightly, it can go away for a period. So far, the AI trade and growth in AI-related businesses has seemingly created a K-shaped economy, with one part of the K going up, another part going down. I think you can see this best on the upslope, the valuations of these AI-related businesses, new highs all the time, IPOs coming to market. On the downside of that K-shaped economy, we're seeing these market gains in a world where University of Michigan consumer sentiment is at all-time low readings. It's a big disparity between what most people are seeing and feeling in their experience of what the economy is doing and gas prices and everything else, and these crazy valuations that we're seeing at AI-related businesses. And it's not just overall consumer sentiment. We can see this K-shape sort of playing out in terms of sentiment around artificial intelligence. I think there was a period where people were dabbling with ChatGPT, using it sort of as a Google search, excited about the implications for what it meant for their lives. That has really turned, and sentiment on artificial intelligence in the US seems very negative right now. We're getting college commencement speakers booed during their speeches when they bring up AI, and even the Pope has recently weighed in on the issue. I think important to note too, I'm hearing this from my kids in my own house, and we're seeing more coverage of it in the media. We're really putting finer points on the potential negative and harmful impacts of AI, especially around power use and increasing power prices near data centers. Some states have been banning data center usage. I hear a lot from my kids especially, and more coverage in the media about the environmental impact that AI is having. So we're really seeing a broad shift towards negative consumer sentiment around the growth of artificial intelligence. And don't forget that consumer sentiment can drive political outcomes. Elected officials will listen to their constituents, and we're seeing already with the release of Mythos by Anthropic to a limited set of customers that the government is asking real questions about where do they sit? Do they need to approve new models as they come out? What sort of regulations need to be put in place on this industry? So it's not simply that we can ignore negative consumer sentiment and this is just happening, but there is a feedback loop through politicians in the US. Calling a bubble is so hard. We've got a history back to tulips in terms of human sentiment, getting excited about making money on the next thing. And over and over and over again, we go through phases where a bubble inflates, and then predicting the timing of or what in the end will pop the bubble has just been sort of impossible. There'll be an investor here or there that gets it right, shorting housing coming out of the great financial crisis, for example, but no one consistently gets calling the timing on bubbles right. I think one of my favorite examples from the bursting of the internet bubble was a fellow investor from Pittsburgh, Stan Druckenmiller, who invested for Soros, is one of the most successful investors ever, got it wrong on the way up, losing money shorting, and capitulated at exactly the wrong time in 2000 and lost money as the bubble burst too. Bubbles have this way of making really smart, long-term focused investors look dumb. Remember that as you start to feel that need and the desire to participate and to start making money, like the early SpaceX investors or whoever else, know that there's a chance that there's a bubble happening, and making big moves around trying to time that bubble can be nearly impossible. I first interned in the industry in the summer of 2000. And my first few years were 01, 02, 03, through the back end of the internet bubble and then the recovery on the other side. And what I can remember from that period is, perhaps it looks obvious in hindsight, but at that time, it is really hard to identify those indicators of froth, incorrect demand, and what's going to turn it. We've heard a lot about token maxing at the largest hyperscalers, where many of the largest tech companies in the country are putting up leaderboards to show which employees are using the most tokens. On the one hand, it's a great way to incentivize playing around with and using these tools to understand how to use the tools better for the benefit of the business. But when you put it up on a leaderboard and you start incentivizing and rewarding token using, you also get all kinds of false demand indicators. I don't believe this will be the thing that pops the bubble, but it's the sort of thing that happens as you go, that when you look at in hindsight, you're like, oh, that wasn't all real demand. Clearly this was a mess. But at the time, it's really, really hard to pinpoint and to make that call. There are definitely some things we're seeing today that seem to rhyme with the internet bubble. I think one of the main things is how any business move in the marketplace towards AI, any announcement of a new AI-related initiative is driving significant change in valuation for businesses. Another rhyme is just the massive amounts of capital that we're burning through across the marketplace. Especially OpenAI and Anthropic are bringing billions of dollars of early investor investment on the promise of profits and an economic model that justifies that spend in the future. But even at the hyperscalers, where they have cash flow to support the investment at companies like Google and at Meta. Remember, this is money being spent on something that we expect to drive returns in the future that's not driving economic value today, that is a big user of CapEx, of cash flow from the businesses. Another piece that rhymes is we're seeing subsidized usage. And I think the leading labs are starting to correct and adjust pricing today, but the demand that we're seeing today is in response to pricing that doesn't cover the cost of providing the service. And this happens a lot. Uber was a great example where you use VC money to convince your customers of what a great service it is, so you lock them in, and eventually you adjust pricing to make profits. But really believing in demand when pricing is much below profitable business levels, I think is something that you need to watch closely. I will say, with the caveat that reports are that Anthropic will generate a profit in the second quarter. As we've looked some at that, it doesn't seem like they will for the year, and some of their costs are understated right now, but there's no question that demand and revenues are growing gangbusters in the space. Another piece that rhymes and that we're worried about is this idea of circular financing. Oracle may be the best example, where they've leveraged the future of the company with debt on AI-related customer contracts. We also see NVIDIA investing in almost every AI-related startup to give those businesses money to buy NVIDIA chips with. Again, I think a bubble is really hard to call. I'm not saying that this is going to be the thing, but these are the sorts of things that you can put together that shows that a lot of what's happening today looks a bit like what we saw during the internet bubble. It's really hard to know who will be the long-term winners in a space. Just the fact that Anthropic has caught up with OpenAI and may exceed valuation and revenue, maybe in the coming months, would have been really hard to predict a year ago, for example. There's so much demand for chips in the marketplace today that even Intel, who it felt like was so far behind, got some money from the government and is now getting business. Google's done great business selling their tensor processing units. There is a lot of market cap in NVIDIA, the largest company in the world today, based on them continuing to lead and be growing or increasing market share at very high prices for their chips. And even this idea of there being so much demand that we need every chip that we can possibly find creates that opportunity for competitive threats to what are thought to be the leaders today. Even in a world where AI is important, of movement amongst the leaders that pulls a lot of market cap out of some of the biggest companies could create this spiral that pops or bursts a bubble and leads to a bit of a retrenchment, even as AI becomes a really important tool for all of us in the future. While there are certainly some things that we see that rhyme with what we experienced during the internet bubble, there seem to be some structural differences today too. I think one of the most important is, as I mentioned, hyperscalers are funding a lot of CapEx in AI with cash flow out of their business. So while there is lots of venture money being burned, a lot of the investment, majority of the investment in this space, is actually coming from cash flows of well-established businesses. That feels different. The business impact of AI on the hyperscalers' traditional legacy businesses also, I think, feels different. I followed Google since before its IPO, and I remember predicting that Google would be bigger than Yahoo one day. It was a crazy prediction at the time that Google would one day be bigger than Yahoo, if you can believe it. But the AI impact on the hyperscalers, Google, Meta, others, legacy businesses. So at Google, not even talking about Google Cloud, which plays directly into providing capacity for the large language models, but just their traditional advertising business. At first, it looked like that was going to be competitively at risk from usage of AI. In fact, Google's use of AI in their traditional ad business has accelerated revenue growth within that business. We saw a huge scale business grow by almost 15% in the second quarter. There are some indications, and not to mention, of course, revenue growth and usage growth at Google, at Anthropic, at OpenAI. There's real demand with real money behind it, behind these large language models. And honestly, in an unprecedented way, we're seeing more growth at a greater scale than we've ever seen for any implementation of a new technology. And I think it's important to remember, even if this is a bubble, the thing can run. A smart investor has got a quote that's something like, "I know it's a bubble when I think valuations are ridiculous, and a year later the market has doubled again." So hard to frame that. And with so much AI-driven exposure in the S&P 500 or the ACWI, the major indices, the stuff is going to drive returns. You can't just sit it out. The stuff is going to drive returns, especially if you're a financial advisor in your clients' portfolios. So having a strategy that looks forward and takes account of the idea that this may or may not be a bubble. Even if it is a bubble, it could go on for years. And the downside on the back of a bubble will be worse and go on for longer than any of us can imagine. Like, that all needs to be part of our current thinking when it comes to positioning portfolios today. I'm not ready to call whether there is an AI bubble or not today, but I'm excited to talk through the mileposts that I and the rest of the team at City Different Investments will be tracking over the coming years to help us frame and eventually to answer this question. So the three sort of mileposts that we're tracking moving forward are the demand side, the supply side, and then capital. So on the demand side, we're going to be tracking whether there's enterprise stickiness as inference subsidies end. We're going to be tracking the cost normalization of compute, of AI compute. How much can the large language model labs get the cost per token to decrease over coming model iterations? And honestly, how much demand durability will there be post sort of the novelty phase of everybody trying everything with AI? Earlier this year in April, the Uber chief technology officer, for example, mentioned that they had blown through their entire AI budget already, just in 4 months of the year. Individual spend by certain employees in a token maximizing culture, lots of reports of it exceeding their salary just in the beginning of this year. And it's not clear that this big increase in spend at companies like Uber, that's a big increase in R&D year over year and CapEx year over year, it's not clear that that's turning into return on investment. We're not sure yet whether we're going to see business improvements on the other side of all of this increased spend. Another piece that I think we're paying attention to is a little bit of this idea of, is AI really going to create a whole new screwdriver when we've already invented a screwdriver and the tool works pretty well? We're seeing lots of companies working on new tools, maybe perhaps trying to replace some enterprise software spend by the business. Spinning up a ton of these projects and implementing these projects is a lot of current spend. On the back end, I'm hearing from some business leaders that I know that, those tools maybe don't work as well as the one that they're currently paying for. And there's a real maintenance cost to keeping up the new software that they're developing to replace these enterprise software suppliers. So we'll see after this period of experimentation with new tools, how much of that usage, which of it actually sticks and becomes implemented across enterprises. My prediction on this specific area is that in the cases where enterprise software or SaaS solutions are easily rebuilt, frankly, with AI, it's not that they'll get fully replaced. We'll likely see some price declines in contract re-ups for those tools that then make it much less exciting to build the tool on yourself and replace it because the cost has come lower. And then, some tools, I think CRM tools, as an example, we're finding harder. Companies are trying, but they're finding harder to replicate through AI. And so the work on replacing some of these more expensive, sophisticated tools will just decline and stop. We tried it, banged our head against a wall for a bit. Even as the tools get stronger, it's like, actually, some of these are useful tools that we'll continue paying for. Another milepost we'll be tracking is whether there's inference cost normalization and whether the unit economics close. To give you a sense of how much costs are normalizing, from 2 years, from 2022 to 2024, the cost per token of a GPT 3.5 level model went from $20 per million tokens to 7 cents per million tokens. Now, keep in mind, intelligence is increasing. This is not a 5.5 look at model usage, but at some point, we aren't going to need the fanciest, newest model for all of the work that AI is doing on our behalf. And users will be able to take advantage of that cost normalization and how much cheaper compute is getting across some of the legacy models. Hardware costs are declining. Energy efficiency is increasing. There's so many ways that either are leading to models getting better and more capable, but also for the same capability, prices are just declining dramatically. Another milepost we're tracking is, will the demand persist as we get through this novelty curve? One great example is the consumer space, and there's been a ton of focus on the enterprise space at both Anthropic and OpenAI. But OpenAI really started as a consumer-facing business. Earlier this year, OpenAI reported 900 million weekly average users, which is incredible uptake, the fastest uptake for a new consumer technology product in history. That said, they've only converted around 40 million of those into paid users. They're paying for a whole lot of inference for customers that aren't interested enough or haven't found the uses so far to start paying just, say, $20 a month for the paid tier. So what sort of conversion they get in that consumer space could be a great leading indicator on this demand persistence past the novelty stage. Anthropic has been all enterprise and to their benefit in terms of revenue growth and market capitalization. OpenAI seemingly has refocused on the enterprise and has dropped some consumer-related spend as they've run out of compute to build all of the different businesses that they're interested in building. Google recently had their conference, their I/O conference, and at Google, it feels like a little bit like a very roughshod approach with lots of products and lots of different areas. But actually, they might be nailing this consumer use case better and layering AI into their consumer products exactly where their consumers are using them. It doesn't sound like a sort of a solidified single enterprise use case, but much more of a consumer focused, meet the consumer where they are across our products. And I worry about how much consumers are going to be willing to pay for these services. But on the other hand, especially at Google, it'll be really interesting to see usage growth and how that supports demand growth in the marketplace. There are a handful, as I mentioned, of supply side mileposts that we'll be tracking. I think number one is the ability to deliver on all of the CapEx plans that the hyperscalers and the large language labs have announced. There are real constraints in terms of the ability to get the chips, to put up the buildings, to get zoning done, and especially in terms of power. Where are we going to find all of this power to power these data centers? Watching actual execution against CapEx plans will be a really important milepost on the supply side. I think this is an area where honestly I'm seeing some yellow flags. Back to circular financing, and we haven't even mentioned private credit funding so much of this CapEx in the space. There are some real risks if timelines aren't able to be met, and I think very reasonable chance that timelines won't be met on a number of these projects. Another important milepost that we're going to be tracking is just the US's ability to generate the electricity that's going to be needed to power all of these data center plans between now and 2030. The IEA says that something like 20% of the next couple of years, data center builds are at risk because of grid capacity constraints. A joint study between Ohio State and Meta put the growth in that electricity generation from just over 100 terawatt hours in 2024 to a projected need of almost 300 terawatt hours by 2030. Just unprecedented growth in the supply of electricity in the US in order to power these data center plants. Globally, data centers are projected to use something over a fifth of all electric generation capacity by 2030. And a stat that I think is sort of closer to home here in New Mexico and Santa Fe, the state of New Mexico uses just over 2 gigawatts worth of power. OpenAI today uses just over 2 gigawatts of power. That's for all of the industrial and residential needs of every resident of the state of New Mexico. OpenAI's projected growth gets them to 30 gigawatts by 2030. Just a staggering amount of growth in electricity demand. This is a real hurdle. And I will say, on the one hand, I'm excited about the innovation that's happening in this space. I think especially modular nuclear could be a great source of incremental supply that, we can debate it, but I think in many ways is very environmentally friendly. I think the innovation happening in this space could be good for the world, actually, as we think about generating power in the future. But delivering against timelines for new electricity sources, the capacity constraints around the supply of natural gas turbines today, the battery needs that we're going to need against all of this, it creates real risk to the growth in CapEx that we've got projected and baked into market valuations between now and 2030. I think chip availability will be a driver too. Today, there seems to be insatiable demand for both training chips and inference chips in the marketplace. And that drives all the way down the supply chain. We're seeing huge growth in the capacity to build new semiconductors. And if there's one thing I know from investing is, number one, semiconductors are an incredibly cyclical business over history. And then imagine what semiconductor capital equipment related businesses look like. If the end product is cyclical, the building of capacity to make new end product is 5 times as cyclical. And the growth in semiconductor cap equipment today to keep up with projected semiconductor demand is nuts today. It's a big piece of this increasing growth in our GDP. And if we get supply demand wrong in that marketplace, that cap equipment cycle can go away for years. So it's something we'll be watching very closely. We'll also be watching the capital side closely. It's going to take a lot of money to fund the projected investment that we're talking about, embedded especially in current market valuations of the leading AI-related businesses in the US. I really liked when it came out, the AI 2027 sort of case study, fan fiction, if you will. I think it outlines some of the issues that we're going to face in a way that it really pulls you in. So if you haven't checked it out, I'd suggest checking it out. You can do an Audible version on their website, look up AI2027.com. Even just a year later, that came out about a year ago, there were predictions in their case study that I thought were absurd that have come true. 2 of the biggest surround this capital idea. One, that we'd get to close to $1 trillion worth of CapEx spent on AI infrastructure honestly sounded crazy to me a year ago. And as we mentioned before, we're very nearly there. Additionally, they projected that you'd see a market valuation of the leading lab, I called it a fictional name, of close to $1 trillion. We were at much less than that in the marketplace for OpenAI and Anthropic in private markets. And now to have 2 of the private companies leading investment in this space closing in on $1 trillion valuations is just wild. We're going to be watching large language model CapEx and funding ability very closely. We got recent news that Anthropic is profitable in the second quarter. That bears further investigation, especially around, my understanding is that the first months of their use of SpaceX's facility, which they've just taken compute control of, came at discounted rates relative to what they'll pay in the future. But they're also just increasing CapEx dramatically. Same goes for OpenAI. I don't think it's a secret that Sarah Fryer, the CFO there, who interestingly was one of my very favorite tech analysts when she was at Goldman Sachs many, many years ago. She's expressed concern about OpenAI's ability to close that funding gap, to create the revenues and to raise the money needed to pay for CapEx over the coming years. It sounds like she's even questioned whether the business is ready to IPO. Now, I think uptake in use of Codex, their agentic tool, will likely drive revenue growth in these last couple of months and into the next few months that put them back on track for a successful IPO. But there are tens of billions of dollars worth of funding still to fund there before that business gets to profitability. And that'll be a big driver, not just for OpenAI, but for everyone down the supply chain who depends on OpenAI spending money and buying their stuff, including NVIDIA, including Oracle, including many others. So we'll be watching that very closely. An important factor on the capital side here will be how these IPOs go. So SpaceX will be the first one out of the gate. We're expecting both OpenAI and Anthropic to IPO this year. If you see a crack in the demand for the SpaceX IPO, it'll be interesting to see whether OpenAI and Anthropic can get to market. And if they can't, if for some reason that IPO window closes, there are real questions about whether there's enough money out there, whether there's enough petrodollars, how much VC funding. I think more and more mutual fund and ETF providers are putting some of that money into private companies, which is outside of their usual behaviors. There are sources, but there's a limit to the sources of funding once you start talking about round after round of tens of billions of dollars without going public. And this initial SpaceX IPO will be a real tell for whether the window is open for, $1 trillion plus IPOs in this space. Watching the demand side, supply side, capital side mileposts will start to help me figure out my tribe in this debate. So what does this all mean for client portfolios? I think it's a tough question. I think the first thing to remember is that any client portfolio exposure to the large indices has a lot of AI-related exposure already. So the top 10 holdings in the S&P 500 today make up around 40% of the index weighted market cap. We're likely to see a few additions to the S&P 500, SpaceX, Anthropic, and OpenAI if they come public. That'll be very direct increased exposure in the index. So, be aware of the risk that creates within that index exposure, but also know and have some comfort that you've got some exposure to these businesses in the optimistic case where market caps have a lot of room left to run. So most of us and most financial advisors' clients have exposure that helps cover you in that upside case where things keep moving. What do you do in the opposite, in the downside case? I think as always, it's important to have diversification in the portfolio, to have fixed income, especially fixed income that isn't too fancy, that's not playing around with private credit or other areas that might be subtly exposed to everything that's going on within the AI trade. I also think that ex-US exposure tends to be less exposed, and small and mid-cap exposure in the US tends to be less exposed. And we've seen at first that this AI trade and valuation-driven AI sentiment play out in the very largest companies across the country. We've really started to see that play out in the small and mid-cap space too. And that's creating some real winners and losers in that market related to how much of an AI play any of those businesses are, whether it's warranted or just management. I'm talking about it. And if you're not in those areas internationally or in small and mid cap, we've seen some valuation suppression. So market, almost like another K-shaped market here where the valuation of anything AI related is going up dramatically. But those things that are good businesses that continue to grow that aren't at risk from AI in the near term and are performing, we've seen some valuation compression in those names. So we think it creates a really nice opportunity to use passive indexing to get your exposure to the areas that could keep running in an optimistic bull case, but diversify away from that exposure. And we think active is a great way to do that. This idea of diversifying away from the biggest indices. It's hard. It's hard, and especially if we get either the optimistic case and valuation keeps increasing and it's warranted, or even worse, if you get a bubble and you get just crazy increases in valuation. In that environment, it's especially hard. I love this experiment. There's a YouTube video where two monkeys, capuchin monkeys, are asked to do a task, and they're given a walnut as a reward. Both of these monkeys in cages super happy to be doing the task and getting the walnut. Walnut is delicious. They love the walnut. It's great. We'll do the task for hours and hours. When the experimenter introduces a grape, and one of the monkeys does the task and gets a grape, and the other monkey does the task and gets a walnut again, all of a sudden this walnut, which was delicious and wonderful, becomes the worst thing that this monkey has ever been given as a reward. First time one of the monkeys gets a grape, other gets a walnut, he eats it, slowly, watches his buddy get another grape, he starts getting angry. The third time it happens, he jumps up and down, screams, throws the walnut back at the experimenter. This idea of keeping up with the Joneses, that is, when somebody else is telling you about all the money they're making and their AI exposure in their portfolio, it's really hard to stick to that diversification. And even worse, it's really hard not to jump in right when we're almost at the top of a bubble. So this idea of this asymmetry in having your exposure within the indices to the AI trade, which we all do, that part of it's easy. The other side of it though, that diversification away is hard and gets even harder as valuations go higher. So that probably the most insidious thing about creating a portfolio for these set of potential future outcomes is this idea of financial advisors' clients saying, hey, but Joe and Sally are making all this money. What are you doing for me? And potentially even losing some clients because you're not going all in on this AI trade. And then those end clients being forced to sort of capitulate right at the last moment, buy at the high. It's what creates a bubble over and over and over. It's hard. It sounds simple, have a long-term approach. It being more important now than ever to diversify these clients' portfolios somewhat away from the largest things, have exposure, but diversify away. It gets really hard to do as a bubble heats up. I think my overall advice on all of this is be curious, be skeptical, be informed. As a big picture take on it, here's a good economist joke for you. What have the economic impacts been of the French Revolution? It's too early to say. So I've spoken a bit as an economist here, and I've given you both sides. And I really do honestly believe it's very hard to call a bubble. Anybody that tells you that it's not, they're full of it. Now, what do I really think? Honestly, I'm an AI optimist. What I see at City Different, what I see at businesses around us is that our people, our talented, smart, driven people, using AI tools makes them better, more productive employees than they were without the tools. And importantly, way better than just AI being used alone. Second of all, in my experience and the experience of those around me, use of AI tools hasn't created less work. There's this dream of the 20-hour work week and you get just as much done using these tools. That's not how it happens at all. We all have this infinite backlog of stuff that we could get done if we had the time. And as each of my smart colleagues digs into these tools, they start to chip away at this backlog in a way that they haven't been able to before. And so for me, for just about everyone else that I know that's really dug in and begun using these tools, they're working as many or more hours, just getting a lot more done. And how this plays out in the overall economy is I think we're on the cusp of some really cool advances across healthcare, across other areas that will help everyone. They'll start to show the positive impacts of these tools. And I think people need purpose. I think we need jobs that are meaningful for us to be happy in our lives. I think the use of AI tools will create more opportunities and newer and different jobs in the future as we move forward. And on the back end, for better or worse, as we've done over the centuries, over the millennia, human beings will just consume more. If there is increased productivity, we'll make up for it with wildly increased consumption. We'll get lots more stuff, because we all love stuff, at cheaper prices, partly because of the use of these AI tools. So I don't think valuation is ahead of us today. It feels like we're on the cusp of valuation running away and a bubble being built. On the back end of that, there will be a period where it's gonna feel nasty, I promise. Predicting the actual timing, the top, whether we're in it, whether we're not, of the bubble, so hard. So this long-term perspective, being aware, leaning in on use of the tools, I think is really important for all of us, and keeping that diversification within the portfolios. We started this out talking about the two tribes, AI optimists and sort of AI doomers. I think you gotta avoid that tribalism, frankly, in all things. And everything we're doing in this country is getting more tribal, but you've got to avoid that tribalism, not say it's all this or it's all that. You've got to understand the nuance in the middle, because that's where the truth lies. So often it's the case that that's where the truth lies. And thinking long-term and making good decisions for your clients without banking on one or the other sides of this tribalism, I think is clearly the best path forward. Our job as analysts, portfolio managers, investors at City Different, honestly, is not to pick a tribe. It's to do the work, to understand the nuance, and to manage our client assets as best with eyes wide open in this quickly changing future.